Hey guys, Dave with Moniology on Markets. This is the weekend market review for February 16th and 17th, 2019. For those of you new to our videos, what we try to do here is analyze the markets from a weekly perspective, try to remove the short-term noise in the markets, and help us get better understand what's actually taking place and give us some probabilities as to what the direction might be going forward. So let's take a look at some of the more important sectors in the market. Obviously, this is not an all-inclusive list, but it's I think it's a very helpful starting point for our research. So starting with the 10-year U.S. Treasury yield. So the Treasury yield here, on the one hand, looks to be possibly bottoming. Here we've got some double bottom both in momentum as well as in price, and so I don't have a strong opinion here as to the next move here, but it is below a rolling over 50-week moving average, same with the Bollinger Band, so we might have a bounce here, but I think at some point we're going to revisit 2.5, possibly as low as 2.1 here to the downside. Now here's a ratio chart of the 10-year U.S. Treasury versus the 2-year Treasury yield. And what's interesting about it, and it's not as clear here, but it's very clear in the daily chart that I've been analyzing. And basically when the 10-year breaks below the 2-year, that's an inversion. And typically that's a sign that the markets are anticipating weakness. And so the last couple of times this happened is here in late 2015, and then what happened when this inversion took place in this breakdown in momentum? We had a pretty nasty sell-off in the market. Looking forward here to 2018, we had something similar in about October, November, and what happened here in December? A nasty sell-off. Well, this trend line is breaking once again to the downside, and it's actually breaking pretty hard on the daily. So if this can't rebound and the 10s can't start outperforming the 2s, it's very possible that this can be foreshadowing more market volatility in the coming weeks and months ahead. So keep an eye on this one. So gold. Gold here it's been an obviously very noisy chart here since 2014. It's just been basically flat, oscillating between 360, 370 in the high. We had a couple breakdowns, but between 1100 and 1400 basically, and signs point that this particular move is one that's probably going to, at least for the short term, break above this 1400 barrier. It's just the momentum is so strong here. It's stronger momentum today than when we were at much higher prices. And when you look at the various miners, and this just reminds me a lot of 2016. And but we started from a higher base, and what that means is that this move probably takes us to 1400 or 1500 at a minimum at some point this year. So very exciting for the precious metal space. High yield bond index, as represented by the J&K. This one's very interesting because as credit goes, so does the market, and I think that on the one hand here, the credit started to break down, and that started talking about how the markets might see increased weakness, and that's surely what happened. But this has been a V-shaped recovery like I've never seen. And not only have we broken to new highs, but we're doing so with momentum breaking out to new, not yet to new highs, but certainly breaking this downtrend. And so, whereas I look to this and say, if I have the bearish picture and say the market wants to move lower, but it's not the case here. So the credit's telling me that the economy is actually shaping up fairly well, and that's a positive sign for bulls. Looking at crude oil here. Now crude oil is interesting because we've had this nasty sell-off here right about this point of momentum was the breakdown point. We've had a very strong rally here, and we've got rolling over 50 and 200 week moving averages. We've got the 50 week crossing over below the 200 week, as well as the Bollinger Band. There's going to be a lot of resistance here at that 58 through 60 level. If it can break through that level, I'm a very strong bull. Until then, I defer to the bear side, and ultimately, I think we will probably tag these moving averages, but it remains to be seen what happens thereafter. I'm very interested. But you see, PPO has indicated there is momentum here, and it could be for a few more weeks. So Nasdaq Composite here, you've got a very nice move from the lows of around 6,200, and now we're shaping up in this bearish wedge formation. Now that doesn't mean it's going to break down to the downside. It could always break out to the upside, but these bearish wedges, probably 70 to 80%, do break down lower, at least in the short term. We haven't yet broken above this this downtrend in RSI on the Nasdaq, so it's going to be very interesting to see if it can muster up enough momentum to break higher, or if it's going to break lower, at least in the short term, for some further consolidation. Looking at the Nasdaq equal weighted ETF, so this one obviously broke down here in I would say in December, late November of 18, and now we're retesting it from the downside. We're retesting it with lower momentum. So then, well, actually, I wouldn't say it's lower momentum. It's basically we're retesting the very point that we broke down from right over here. So it's going to be very interesting to see what happens right over here. If it breaks higher, that's the bullish argument. If it rejects, then that would be the bearish argument. Russell 2000, same thing. So Russell is retesting this momentum downtrend right now, and it's going to be interesting to see what takes place at this point. Right now the price action is great. It broke above the 50-week moving average. Probably a lot of shorts covered over here, which is why we had such a beautiful hammer pattern. But even here, this is a bearish wedge, and you know, I'm watching from the sidelines because ultimately I don't have a strong opinion. I'm just showing you what I see. Now you've got the S&P equal weighted as represented by the RSP. Here's what I see. We've broken down here, and now we're retesting it from the upside. Momentum is basically approaching the level of breakdown last time around. So again, a lot of resistance is to be expected. And notice the volume, the lower volume here on consecutive weeks. You see this in almost every chart that does show the volume. So that's something to be cognizant of. Now here's the S&P 500, same thing, lower highs in momentum, and so with a bearish wedge, that's typically not what you want to see from a true bull market. But you know, I remain open to other perspectives, and I look forward to your feedback. Here are some underlying important sectors in the market. Here's the semiconductor. This one looks great. I mean, this one broke out, and there's not much to say aside from there's going to be a lot of resistance at that 1400 level, and we are in this wedge formation. So I could see us breaking lower here, but in the meantime, the momentum looks fairly strong, and I like the setup of this chart. The transports, they look the weakest of the major underlying sectors in the market. You've got the lower peaks here, but this one hasn't even hit this. So on the one hand, you might say it's got some more momentum to go to the upside. That's very possible. But on the other hand, you want transports to actually be leading the way in a healthy economy, and that's not what's taking place right now. So multiple lower peaks in price, multiple lower peaks in momentum. That's not negative divergence, but it's certainly something that suggests that this rally might not have much staying power. A couple more charts here. The U.S. dollar. I'm of the belief that we're in this topping formation, and I'm getting this perspective from multiple time frames, but this one shows multiple lows in momentum despite price hitting triple top. That suggests this rally is on its last legs, in my opinion. We're likely going to test back lower to that 92 level, and if we do break it, I have no idea whether we will or not, but if we do, there's a lot of downside here before we ultimately resume higher longer term. The volatility index. So the VIX, I've been analyzing the VIX from various perspectives and various different. So this is the S&P volatility index. I've been looking at the Nasdaq, the gold, etc. And what I'm seeing here is a lot of these wedge patterns, and these wedge patterns are bullish, just like the others that were bearish. This bullish wedge pattern typically resolves itself to the upside. So we're here at the very tail edge of that, the peak of that wedge, and so I'm curious to see what happens. My hunch is that we move higher soon, and that's going to coincide with the bearish wedge breakdowns on the equities. Finally here, the MSWORLD ex-US world market. And whereas I am seeing some very positive ratio charts when you look at European stocks versus domestic, U.S. domestic, emerging markets versus U.S. domestic, they are breaking out, and that's positive. But at the same time, you look at this, and this is still in the downtrend, and it hasn't even hit this backtest line here. We have closed the week slightly above the 50, which is a RSI level, which is positive. So there's a lot of upside here before we hit some resistance here in RSI. But that being said, if this cannot recover the 200 and the 50-week moving averages coinciding with this lower declining trend line, then that's not a positive sign for world markets. But anyway, overall, I'm just saying that there are a lot of mixed messages here, and it's better to stay on the sidelines to see which way they resolve themselves, unless you are a precious metals bull, because there's a lot of upside there right now. I think I like bonds, I like fixed income right now still, and there are some other sectors worth considering, and just keep an eye out for my Twitter posts throughout the week for my perspectives. And just very quickly, guys, for those of you new to our videos, I want to share briefly an exciting note that after my CFA Level 3 exam in June, I will be launching a premium subscription service. It's more of an education, financial education and coaching service, and I've opened this up only to 100 slots. We've got 25 folks who have already reserved their spots, so if you want me to reserve a spot for you, please send me a note at dave@moniology.com and let me know. There's no obligation until July, and I think it's going to be a great service. I think it's going to be a great group of people who are committed to becoming better investors, and what I want to create is a community around the concept of it's not only about finding stocks to go long, but it's about understanding one's own psychology, creating one's own methodology. So you're not relying upon other people to tell you which stocks to buy and when to sell, because ultimately that's a recipe for disaster. And I want to create something different, something unique here, and with your support, I think we can do some great things. So appreciate your support, appreciate your follow on StockTwits, Twitter, and YouTube at Moniology, and I look forward to communicating with you and hearing your feedback. Have a great week.